All right, I'm Michael Hartzman. Today is Tuesday, July 15th, 2025, and I'm on as always with my partner Dominic Tavella, both of us live from Long Island. We have Nassau and Suffolk County covered. How are you, Dom?
Doing well, Mike. We're a great time of year to be in New York. So grateful to be here, and we'll hopefully get some good weather the rest of the summer,
Yeah, we had quite a storm last night, but not as bad as New York City. But
or
yeah,
or other parts of the country. So grateful, if we can say it out loud, grateful to be in New York.
it is the middle of July, so we shouldn't complain about the heat because, as I said, it is the middle of July. It's summertime. Um, So look, let's just get right into it, Dom. Another I would call last week a quiet summer week. Virtually nothing happened. The S&P was down a third of a percent. The Dow was down about one, and the Nasdaq, I mean, I don't even know how you measure this, 0.07. So virtually unchanged, which really is almost
Now,
impossible.
I'll call it flat
Yeah.
for the week. But yeah, Mike, typical summer months, whether it's a lot of the brokers, Wall Street takes a little time off, whether we do go through a quiet period where we don't get a lot of economic data, we don't get a lot of news from the companies themselves, profits, earnings. So it's not surprising that it kind of was a quiet week for the market. So we'll take it once in a blue moon, slightly down, I'll say, for the week with the Dow down a little bit more, but overall, not. We'll take a quiet week after all the noise we've been living through year to date.
Yeah, look, the noise, even when it's quiet, there's always background noise, whether it's interest rates or inflation or what's happening in Europe or tariffs. It does seem endless at times. And I guess this morning we got the inflation data for the last month and the market didn't overreact because it was what the market expected. But here's a big shocker. Inflation is creeping back up as you and I expected, as many economists expected, as a result of these tariffs starting to really show themselves.
Yeah, and that's the big question mark here, Mike. It came in, if you look at the headline, as expected, but as expected was 0.1% higher than the prior month's reading number. And sure enough, it came in higher. The cause, we can dig deep into the data, but it is being blamed on the already embedded tariffs, and those tariffs have created quite a bit of revenue, tax revenue for the tax collectors in Washington. So there seems to be some cause and effect already, just by what's been put in place. Whether it's permanent or not, we're going to discuss that, I'm sure, tonight a little bit. But we are starting to see that higher cost creep into the actual data.
And the Federal Reserve was very, very close to their stated target rate of 2%. And again, we beat this subject to death as well. Powell said in December they're going to put their interest rate lowering on pause until they knew the effects of the Trump tariffs. 7 months in, much to the consternation of the administration, they've stuck to their word. He stuck to his word, and so today's inflation data. I mean, what do you think? I mean, to me, it kind of validates to a certain degree Powell's reluctance to lower interest rates, doesn't it?
I don't know if it'll completely justify it, Mike, but it might if the status quo gets worse. Now, even though we had a really quiet week in the markets last week, the weekend, we saw another tweet, another announcement from the White House, and the re-implementation of some significant tariffs, an announcement against the European Union and against Canada. and then some more announcements, I believe, yesterday. So the question is not so much even the tariffs that we have in place now, and this really is Chairman Powell's conundrum, is what are the tariffs going to be tomorrow? So if you're telling me we're going to leave the tariffs at this 10% ballpark number, then the overall implications to inflation should be relatively short term and relatively minor. But you start talking about 30 and 40 and 100% tariffs on some of these countries, the numbers could be ginormous. And then you got to believe a significant portion of that gets passed on to the consumer. So Powell's stance, which I understand, is hey, we don't know yet. And until we have clarity, we're inclined to hit the pause button and not actually take any action.
And here's what's really ironic. We keep talking about Jerome Powell. If anyone, and I don't know why anyone would unless they had to, listen to a Fed chair testify in front of Congress, it's a snooze fest. It's medicine for insomniacs. It's so dry, it's so boring, and all of a sudden, this has become theatrical, right? I mean,
Well, you stole my words, Mike. You're saying snooze fest, but if you actually and I've caught a little bit of it. I don't have a life, Mike. So yeah, I'll watch some of that. And it really is theatrical because it all is about the show and the big long speech without allowing anybody to actually answer a question. So there is almost a humorous, comical aspect to it. But at the end of the day, and I think that the probably the most appropriate commentary coming out of Chairman Powell's mouth is, I would have lowered interest rates already if it wasn't for the unknown of the tariffs. So whether he means it, whether it's a little pushback on the rather aggressive stance by the Trump administration, he has laid it out there, Mike, pretty clearly that if it wasn't for the unknown, he probably would have lowered interest rates already.
Well, and here's the part to me that's even more theatrical. I think as a result of that comment, now the administration, not very subtly, is actually accusing Powell of committing crimes and lying in front of Congress during his testimony about the renovation of the Fed building. So that's the part to me that's become really a little nutty, that there are these two immovable objects apparently, and something's got to give, because the Trump administration definitely wants Powell out, or at a very minimum the lower interest rates, and Powell thinks he's doing the right thing. And I don't even think it's 100% unanimous within the Fed governors, but he's really sticking to his beliefs.
Mike, so I'm glad you made that last point because I think it's excellent. We can all, certainly Trump is pointing the finger at Chairman Powell, but it is an entire board that's making this decision. An entire board votes on this decision. It is not one singular person that is making the final, maybe Chairman Powell is making the final decision, but it's based on a unanimous vote. Majority vote, excuse me. So you have still the majority of the Fed board that is saying, hey, it's probably appropriate that we be a little patient, at least for a little while longer, till we can kind of see what the outcome of these higher tariffs are going to be.
And here's the part that makes me a little nervous about what I'll continue to refer to as the drama and the theatrics, Dom, is that, again, tell me if I'm wrong. My impression of the Wall Street community is they're backing Powell, not only as a Fed chief, not only as his guidance during this period, but as a person, as a person who's a government servant. And I don't think they're a fan of the bullying. And I don't, and it was clear back in April where they basically, Bassett, the Treasury Secretary, basically went to Trump and said, "You got to tone down this rhetoric." So that's a part that does make me nervous, even if he forces Powell out. If there's just a yes man in there doing what the administration wants, I don't necessarily know if that's a good thing because the Fed, Dom, is supposed to be independent.
So two thoughts, Mike. The first is that, and again, you have to take all this with a grain of salt. We hear this kind of stuff all the time. But should Chairman Powell be forced out, the bond market and the stock market might revolt. That's the way. That's the way they vote on this kind of stuff, Mike. They go, we're not happy. And at least some of the quote unquote experts are talking about you could see a 3 to 5% pullback in the major indices. The S&P, the Dow, the Nasdaq could go down by anywhere from 3 to 5%. Bond market equally, interest rates would might pop higher. You say, well, why would that happen? And this is my second point, it has to do with this inflation number. So not so much that they love or don't love who the chairman of the Fed is, as much as the markets don't love inflation. It is bad. It's bad for the economy. It's bad for the consumers. It's bad for businesses. It's bad for interest rates. It's bad. And so, if the Federal Reserve were to get a little too lax with their interest rate policy, flood the markets a little bit too much, it might reaccelerate inflation. That would be bad.
Well, so let's ping pong back to tariffs because I think that's another accelerant for inflation. You made a comment this morning on our morning call with our advisors. I think the date is August 10th, August 9th. That's the new drop dead date apparently to get deals in place. And your feeling, I don't put words in your mouth, is that they're going to be, or Trump's going to be a little bit more intractable this time and not, kick the can down the road.
Yeah, so a couple of points. First, it depends on the country. August 1st is the first round,
Okay,
uh,
August 1st.
and then some of them August 8th, as you pointed out, Mike. And then you got to wonder. We had this big announcement over the weekend, and the last time we saw a big announcement like this, we could think of mid-April, Mike. The markets corrected 18-20%, and it was a big yawn fest on Monday, yesterday. Like the markets didn't really react to this imposition of higher tariffs on key countries, and the European Union is ginormous. So you have to ask yourself why, and the why, at least my interpretation of it is the market doesn't believe it. Trump has done this multiple times, made multiple announcements on trade tariffs, on specific tariffs on countries, and then pulls it back or extends out the wait period another 30, 60, 90 days. So I think the market still is in the hey, he doesn't really mean it mode. But I don't know, Mike, and I want to go and hope I'm wrong, but this time it just seems like he means it. I think, just my opinion, I don't have any secret sauce here to delve into, but it just seems it's getting under his skin, President Trump, that he's getting a reputation for not sticking to his guns. And so there's starting to be a feeling out there that, oh, wait, maybe this time he really means it. And then in the end, it might get resolved, but the end might be a week or a month later than this target date that he's looking at, Mike.
Look, I don't think anyone would enjoy the acronym that ends with always chickens out, right? So I could agree with his frustration not wanting that moniker, but look, I mean I agree with you. I mean he's kind of earned it because they continue to kick the can down the road. And the other part of it, Dom, let's be realistic. I think the only deal, maybe there's two, but besides Vietnam and maybe the United Kingdom, England, has any other country actually put paper to pen and signed an agreement? So is it reasonable to expect we're going to get 88 deals in 15 days?
It's not reasonable. We historically have seen that these types of treaties can take
Years.
years to negotiate and then even longer to implement. Oh, that's not what we meant. Even though it's in
Right.
writing. oh, our interpretation of that is different than your interpretation. And then they go to the World Trade Commission or some other international court and argue and debate. So I think why I kind of getting the feeling that this time might be different is even the countries themselves are like, we don't need to negotiate that hard. We don't need to compromise all that much because he'll just give us more time to work it out. And I think, and again, I don't have a secret sauce here, Mike. I don't have a secret into the White House, but I'm getting the feeling, and from people that we talk to in the industry, we're getting the feeling that he might be a little bit more tough this time around. I.e., he might actually impose the tariffs and go, hey, when you guys decide to negotiate, we'll take them off. Kind of the opposite of what he's been doing so far.
Yeah, so that does make me nervous, as we get into the sleepy days of summer, and you and I have seen summer sell-offs, and they're not pleasant because a lot of people are away, and it doesn't take much to kick the underfooting out from the market. And as you were saying that, I was just looking at the volatility index, which is a good measure of people's fear in the market. And the volatility index began the year at 1793, hit a high in April the date you mentioned, when the tariff started, of almost 50, 47. And guess what? The VIX right now is lower than where the year started. So there is this enormous disconnect between what might happen and I think what investors are not worried about, which
So,
gives
Mike,
me a little.
to put you on the spot, is that complacency? Are investors a little bit too complacent that, oh, it's just all going to work out? Are they
Yeah,
not looking at the weather report?
they are not looking at the weather report because at the end of the day, we carry our umbrella and we never need it. Yeah, I think investors are too complacent. I think to your point, they assume that the can will be kicked down the road again. And you and I began been talking about this data that's going to come out for the last month and this in the last quarter. It's going to show, in my opinion, cracks in the economy. And look, my glass is typically half full, but I don't understand why, other than AI being on this crazy run and technology kind of leading the field last week or two, I don't know why people are ignoring, the real data. They're just ignoring the real data.
And I want to bring this up later, so remind me if I forget how the average investor is actually beating the professional investor year to date. So we do have to spend a little time and maybe kind of I'll look in the mirror a little bit. But I think you hit the nail on the head, Mike. I think that's exactly what's going on. That I want to go, the professionals are looking at the real data, and the average investor out there, the retail investor, is going, oh, I'm not really worried about it. It's all going to work out. And you look at where they're placing their bets, and you're looking at these large tech stocks that are involved with artificial intelligence. You look at the cryptocurrencies. You look at some of these other more speculative investments, and oh my God, Mike, they've done insanely well year to date.
Yeah, and look, you and I both agree. It is going to all be all right, and it is all going to be okay. Long term, I'm not pessimistic at all. I just think, as we go continue to creep into the next couple of days and weeks, there's going to be more economic data in the short run that's going to make people maybe a little nauseous. If Trump sticks to his guns, that's going to make people a little nauseous. If they continue to fight with Powell and Powell continue to dig in. So there are just underpinnings at the moment that I think should give investors some hesitancy to just continue to dive in head first.
Well, and so two particular points today, when you brought up the inflation number, let's be honest, it was just slightly, but higher. right, Mike? And yet, when you look at things like energy prices and real estate and things like it should have been lower. And maybe you could argue the inflation data number should have been significantly lower, but yet it ticked higher. And I thought a real tell in today's number was average hourly worked actually declined. The average worker worked less hours than the prior, I think, prior month. So I don't think they're all taking summer vacation, Mike. I think that we're starting to see the job cuts really affect the data numbers, the employment numbers being softer than they were last month and the month before, unemployment slightly ticking higher, and retail sales have been holding up. But when you dig into them, there as well, they've been hurting. The average consumer out there is hurting.
And here's the other part of it, Dom, and I say it 1,000 times, and so have you. It's all about the news bubble that they're in as well, right? So I go to Fox News, and the headline is a shocker, is about Joe Biden's auto pen. And there's nothing here at all about inflation or the jobs number. And then I go to the Huffington Post, which is clearly a liberal website. And the story is right in the front page.
Wait, Mike, we've been wondering for the last couple of years who the one person that still reads that is. That you?
That
Is it
is
you?
me. That is me. Just for research. I have to do this research.
Got it. Thanks.
Inflation surges amid Trump tariff madness. So there you go. Nothing to see here. Trump tariff madness, right? So that's the other part of this, I think, which is, confusing to an investor.
Yeah, I'm sorry about the joke there,
No,
Mike,
you're good.
but but it went up one tenth of 1%,
I get it.
and the headline is it surges, right?
Exactly.
And I can't dispute the madness part, but I can dispute the surges part, right? So, again, we joke sometimes, and maybe even our analogies about looking at the weather report, but there are storm clouds out there, and we are going through a period now where we're going to see some real data and some real events come to the top of the headline. So a little bit more volatility. I think that VIX that you like to talk about all the time, Mike. Would you be surprised if VIX were substantially higher over the next couple of weeks? Would you be surprised at all, Mike?
No, no, I kind of expected to. And anyone who wants to look at it, the symbol is VIX, Viking Indian X-ray. And look, it's just you could call it anecdotal, but it's just a measure of volatility and I guess the velocity that people are selling securities. Would that be an accurate statement?
Yeah, I think it also measures options trading, puts and
Hmm.
calls. So it kind of is a measure we use in our world to say, hey, how volatile these markets are and how much risk there is in the market. So the higher the number, the higher the volatility and risk. But we've been around for a long time. When we get to those really, really high numbers that you quoted, Mike, that usually is a pretty good buying opportunity, right? That's and when it's really, really low, implying very low volatility, you might be want to be a little patient in your buying and wait for the more opportunistic time. So we definitely look at that data. I don't expect our average client to do that, but we do.
Yeah, absolutely. And then the last point, before we take our break, is is the European market, Dom, continues to surge, and it seemed to now lapped our market 3 times. The European index is up almost 20% year to date. You can't ignore what's going on there. And when a couple of clients, friends, investors have said to me, well, that's because they've lowered interest rates already, as if that's the only benchmark. I don't think that's entirely true. I think it's a part of it, but also they took a lot longer to come out of the pandemic, and their economy really suffered for a much longer time than ours ever did.
Much more so. We came out of the pandemic way faster than they did. So they have a lot more to, even as much as those markets are up year to date, and you said it, Mike, at about 20%. They have a lot more to go to even to get close to where we are today from a valuation perspective. And certainly they've lowered interest rates now a couple of times this year. That's helped stimulate their economy. They also increased their defense spending very, very substantially as a result of the Ukrainian-Russian war. They've made a huge commitment to spending money that stimulates the economy. And then there's my word wonky, at least once a podcast. Um, the US dollar has weakened against foreign currencies. So, just in plain vanilla, if nothing else changes, when the dollar goes down in value, the euro, like a seesaw, goes up in value. Well, if we have shares of those companies, those European companies, even if from a valuation perspective they haven't changed, the value of the euro makes the value of that company higher. Here's a shocker: the euro versus the dollar. The dollar is depreciated somewhere between 10 and 15% year to date. So, of the 20% that European stocks have gone up, I'm going to say 10 to 15% is a currency valuation. The rest is appreciation in value, like our market. So that's, by the way, is likely to continue, Mike. The experts, quote unquote, think the dollar continues to devalue through the end of this year. But a big component of why those securities are worth more than ours year to date is the devaluation of the dollar.
It's a great explanation. Thank you for that. I know you spent a lot of time in Europe, so this is obviously a subject near and dear to your heart.
Well, not only near and dear, but my wife is awfully upset. I can't use the proper language, as now everything is more expensive in Europe. You might remember just a couple of years ago, Mike, and I think you were there as well, where the euro and the dollar were almost equal. So it's like, yee-haw, I'm literally buying stuff that's on sale. Today, that same product is roughly 15% more expensive than it was
Yeah.
2 years ago. And that's what we mean about the valuation of these currencies.
Yeah, yeah, you're right. I was there once when it was even. I was also there once where a dollar cost me $1.40 of a euro. So,
Not unfortunately that I was there, but unfortunately I was there as well, Mike, when it
yeah.
was $1.30, $1.40. So theoretically, you were paying 30, 40% more for that product, right? We won't say pocketbook, wink, wink, wink. But but again, the experts think that does continue through the balance of this year. We'll see. The tariffs might affect that as well.
So let's stop here and let's take a break. And when we come back, Dom, we're really gonna go into the one big beautiful bill, the official name. We're gonna use it. The one big beautiful bill that was passed with again a lot of consternation, a lot of ink being dropped, a lot of back and forth fighting. At the end of the day, let's break down what it really means to our clients and listeners. I think they'll be surprised when they hear what the actual impact actually is.
The actual impact, yes.
So we'll be right back after a quick break. All right, I'm Michael Hartzman, back with my partner Dominic Tavella on the Lebenthal Report. So, Dom, we spent the first half of the show talking about economic conditions and the market. Um, we decided tonight when we didn't have a guest or didn't want a guest, so you and I could kind of break down this new tax bill. Um, and look, I have to give the administration and Congress and Washington credit. Normally, when something is expiring December 31st, they don't even start thinking about talking about it till Thanksgiving. So,
And that's probably being generous on your part.
yeah, exactly. So the fact that they actually got this thing done on July 14th, I am shocked. Glad I didn't bet on that. And I'm happy that we could take, this uncertainty out of the equation. So, as I said before the break, this bill got a lot of attention from both sides. It's either the greatest thing since sliced bread or the worst thing, since locusts, descended on populations. And I think the truth is neither of those two things are true, right?
So to your first point, President Trump said he wanted it on his desk for signature by July 4th. Mike, I would have bet the house that wasn't going to happen. So you are, I think, exactly spot on that these things never happen on a timely uh, scale here, and God forbid if they don't have a gun to their head to make them do it. So you are right. Kudos to them. They actually got it done, and primarily because at least we don't have to think or talk about it anymore the rest of the year. It's a risk that we don't have to deal with. Now, what did they actually get done? The English translation, let's start with the tax rates. They left the existing tax rates alone. So, this argument that there were going to be these big, ginormous tax cuts by one of the parties, it was not factually
Wait, wait,
correct.
wait, wait. Say that again. You mean they left the tax rates alone?
They unchanged. So there are some subtleties. We'll get into that. But the basic corporate tax rates, the basic income tax rates, they have left the basic tax rates in place. So you and I talked a lot about this, Mike, in the past. The bill that got passed, the big, beautiful bill that got passed, was to prevent a tax hike
Mm-hmm.
next year. So
Mm-hmm.
by signing this bill, it basically froze these tax rates in place, which is a positive, but it doesn't add any stimulus to the economy, right? We're all going to be paying the same tax rates as we were last year, as we expected that we would pay this year.
Right. It doesn't create any stimulus and it doesn't create any additional revenue in theory either. It just kept what we had in place. Um,
Exactly right.
the one thing that they did do, especially as it affects us, living in New York, living on the East Coast, a lot of people were upset in on the East Coast and the West Coast when they really cut the state and local tax deduction back then to $10,000. And what they've done, at least for the next 5 years, Dom, is they've capped that now at $40,000 for incomes at $500,000 or below. So I think that does, make some people on the east and west coast, especially a high tax state that we're in, feel a little better. I mean, that's definitely a benefit to folks who live in New York and California and whatever.
Yeah, that's probably one of the best things that came out of the bill. The again, the tax rates are the same now, but they had limited in past
Hmm.
bills how much you could deduct of your real estate taxes, your state income taxes. So for a state like New York or New Jersey, Illinois, California, shockingly Democratic states, Mike,
Right.
the loss of those deductions really hurt. It really hurt the middle class, Mike, and that's probably the most troublesome. Again, there is a cap if you make, I think you said $500,000, Mike.
Yep.
Uh, then it goes away. But most average people make less than that, and they were the ones that were hurt most by the loss of this deduction. So getting it back, or at least a piece of it back, I think is a good one. It's a positive in this. I'm glad they did it.
Yeah, me too. And and now I'm just going to Google real quick the whole no tax on tip
Yeah.
scenario because that got a lot of ink, and I think that also got a little bit of hyperbole on how that actually works. Correct?
Yes, and then you might as well look at no tax on overtime. Again, when you start reading what it actually says, and then we're going to get into the conversation what it actually means, because those are two different discussions, but not quite the headline that people think. So,
Hmm.
overtime number, Mike, it's the differential between your hourly rate and the overtime hourly rate. That's the portion that doesn't get taxed, not the whole thing. So in English, if you think of a typical contractor and he gets paid time and a half on a weekend, it's the half that doesn't get taxed, not the whole thing. Right. So even though it's all overtime, only the differential portion is actually not taxed. So again, the headline looks, oh my God, I'm going to be able to work and make all this money tax free. A small component of it is actually tax free.
Right. And look, I don't want to be, completely jaded, but Dom, when you get a piece of furniture delivered or, you get a pizza pie delivered, do you really think the person you just slipped 20 bucks for is putting that on their 1040 to begin with?
Well, again, let's forget about the nuances for a second. But if you think about it, two particular issues. Number one, how many of these people are really reporting the tips in the first place, Mike?
Right.
Let's be honest. Now,
Right.
obviously, you're a restaurant, it goes on your credit card, it goes on the bill, that
Right.
shows up. But as you said, you're tipping somebody 5 or 10 or $20. They're not running and reporting it on their tax returns. That's number one. Number two, let's be honest. Typically, these are not high tax earners,
Right.
right? So if you think about whether they even bother to file a tax return at all, when they do, they get the standard deduction or they're at a very low marginal rate. What the government is giving up in tax revenue is just minimal, Mike, minimal. So again, good for these people. Let them keep their tip money. I'm all for it. On the other hand, the economic effect of these overtime tax issues or tip tax issues are minimal at best. Minimal.
Yeah, and I think the other one that got a little blown out of proportion, Dominic, is Social Security. And now,
Well, that's
yes,
a big one, Mike.
what?
Blown out. That's a big one blown out of proportion.
Right. So you want to get into that a little bit?
Again, I'm going to kind of outline it, understanding that Congress writes the laws and the president signs it, and then it's up to the IRS and the staff to actually interpret what it really means. But there's no such thing as no tax on Social Security, Mike. It just didn't happen. Again, I apologize for using the word wonky twice now, but your adjusted gross income, the amount of total income, including the portion of your Social Security that gets taxed, stays exactly the same. But if you are over 65, Mike, is that
Yep.
the
Yep, that's the
age?
number. Hmm.
You potentially can receive an additional deduction of, I think the max is 6,000 per party, right? So
You
husband and
got
wife
it. You
get
got
get
it. Yep.
60,000.
So
But
6,000 a person, 12,000 a couple.
a couple against this total income, which includes W-2s or dividends or interest or Social Security. So it's deduction against your total income as long as you don't go over a certain income limit. So here's a shocker, Mike. Half the people in this country don't pay tax on Social Security already.
Right. Right.
They don't. Let's be honest. So there are a portion of people out there that will benefit by this, but not anywhere near the headline making noise that your Social Security is not going to be taxed. Potentially, some of it may not be taxed. More accurately, potentially, some of your income may not be taxed, but as long as you don't go over certain limits.
Right. And then just to be clear, these two things that we just mentioned, these are not that any tax law is permanent, but these were written to be temporary. The Social Security one expires in 2028, and I think the tip one is good for 5 years. Or do I remember that correctly?
I don't remember it, Mike, so I won't stick my foot in my
Okay.
mouth. But I'm gonna go whatever you say. I'm gonna go with.
Yeah, I mean I may be winging that part, but I know they're both temporary. Um the one thing that they did do, Dom, which I think is very, very good. Oh, that one expires in 2028 also. So they're both good for 3 years. I apologize. They did leave the amount that they left it, they actually increased it a little bit. The limitation on gift and estate tax exemption, that was also at risk, and they actually increased it from virtually 14 million to 15 million, which is also indexed for inflation. So some people in the insurance industry thought that that would be one thing that was cut in an effort to pay for this thing, but they left it alone, which is good for business owners and people who own illiquid assets. This was a big fear that they would suddenly go from not having an estate tax bill to having an estate tax bill. And I think it's good because it's not really a huge revenue generator. It's a
Well,
huge
it could have been.
headline generator. What?
It could have been a huge. Now,
Yes.
historically, it has not been a big revenue generator,
Yep.
but that's because they increased the limit, right?
Right.
Where now we are talking about the 12 and 14 and $15 million exemption, right? But you and I have been in the industry long enough to remember what it used to be, what, 600,000, Mike?
Yep.
So in English, this was death taxes, right? You die, your value of your total estate is X, and if it's over X plus, it gets taxed, and rather harshly.
Hmm.
They've done away with that because mostly it affected small business owners and farmers and people that had built up family estates, and it really punished that sort of middle class type person, family. This way, it kind of really goes after the big boys in the game, and leaves the kind of the middle class, upper middle class alone. I think that was a good one, Mike. I'm glad they left it alone. But there was some serious talk about lowering it and maybe lowering it dramatically because of the revenue increase that we would have had.
Yeah, exactly. And I agree with you because a lot of people who fall into that category are small business owners or as I said, have illiquid investments that you just can't turn around and write a giant check to the government without liquefying something that maybe
Yeah,
shouldn't be liquefied at that moment.
yeah, creating a fire sale where you're forced to come up with the money in a relatively short period of time. I think a typical is 9 months after death. So again, that's a good one. Not in terms of stimulating the economy, not in terms of adding to GDP growth, but in terms of punishing people, families. I think it's a good one that they left alone.
Yeah. And the other call I get from clients, and I know intellectually people understand the difference between Medicare and Medicaid, but I think, when they get caught up in the news cycle, obviously everyone internalizes it. How does it affect me? And for the most part, Medicare, which everyone gets at 65, they left alone, and it was Medicaid, which I don't think anyone would disagree. There is a lot of fraud, waste, and abuse in that system they've tried to fix. Unfortunately, as you said this morning, there's a lot of unintended consequences in how that gets fixed. A lot of, I think, innocent people, especially in rural areas, are going to be negatively impacted by that.
Yeah, so again, maybe stating the obvious, Mike, Medicaid is health insurance for poor people, people who are uninsured. And so you think about a family, they have an event. What do they do, Mike? They go to an emergency room,
Mhm.
have no insurance by law. the emergency room, the hospital can't kick them out. They have to provide them with healthcare benefits. They
Hmm.
fix them, they take care of them, whatever. But then the million-dollar question is, who pays the bill? And
Hmm.
so typically the hospital, the doctor is going to go to Medicaid and go, hey, we had an uninsured, we had a poor person come into our facility. We provided them $10,000 worth of benefit. We want to get paid. Well, this government, particularly saying, hey, wait a minute, we're not going to write a blank check for those benefits that you are providing. And I believe it's a very targeted effort, Mike, because let's be honest, a lot of the states were using this system to pay for illegal immigrants coming into the country, not
Hmm.
just poor, Mike. The way the system works is you just have to be uninsured, right? And you theoretically qualify for benefits. So this administration is cracking down on that, and we expect that there's going to be some significant issues with how much they're going to willing to pay doctors and hospitals and prescription drugs and things like that. And some rural hospitals that very much depend on these reimbursements might be punished as a consequence. They did provide some language and some benefits specifically targeting rural hospitals, but I think there's going to be some unintended consequences of this specific new law.
And what do you think those unintended consequences are?
Well, so the facilities themselves, let's just hypothetically talk about a hospital, they count on these reimbursements to provide services, right? So if they're not getting reimbursements, they either have to try to limit the services, limit who they're providing the services, which again, they're covered by law. Or here's the shocker, Mike, they're going to have to raise prices to where they are getting reimbursed. So the insurance companies that are reimbursing them, the patients that are going in and writing checks themselves, I think the cost to those entities goes higher to make up for the cost of not getting reimbursed on the other side of the fence.
All right,
Or they
so
go bankrupt, or they just go
yeah,
bankrupt.
no, I know. It really is a terrible situation, and I think they really took a sledgehammer into this thing, just like they did earlier this year with all those Doge cuts. And I do think, unfortunately, a lot of people are going to get swept up in this who do not deserve to be swept up in it. Just to switch gears, whether we could argue this increases the deficit, is revenue neutral, it probably increases it a little bit. Um, when does anyone start caring about the deficit again? When does that matter? Seems like it has not mattered for a very, very, very long time, no matter who's in office, no matter which party's in power.
Well, two things, Mike. First, the Democrats have argued that this explodes the deficit even
I know.
um, the way the CBO scores this bill, they don't factor in a lot of the outside stuff. They use a very low growth rate in economic growth going forward. And the higher the growth rate, the higher the tax revenue, right? So that makes it look worse than it probably will be in the end. The economy should grow faster than what they estimating, and more important, and we saw it this past month, Mike, the tariff revenue was positive. It was insane how much this administration has already collected in tax tariff revenue so far. Depending on what the final settlement ends up looking like over the next 5 to 10 years, that could offset the
Mhm.
cost of this bill, could offset. We don't know, Mike, right? That's the million-dollar question. In terms of when do we start caring about the deficit, I want to go where we're all now looking at the annual interest payments on the deficit. It's just ginormous, Mike. We spend more on interest payments than we do on national defense. It's
Right.
crazy number. So I think it's starting to worry the average person. I think it's starting to worry uh, the average taxpayer. It's starting to worry the average politician that this becomes a black hole that we eventually will not be able to get out of. The markets seem okay with it so far, but you have to believe, Mike, that sooner or later the manure hits the fan.
It's really interesting. I mentioned Doge and the deficit, and the person in the epicenter of both of those is Elon Musk, right? So Elon Musk went from being the Democrats' boogeyman, their Darth Vader, to being their North Star, because he really, look, I'll never know, you'll never know what conversations he had with Trump and what really caused the spat. But he does seem to be generally concerned about the deficit, and one of the few people with a megaphone that is actually, trying to bring it to people's attention.
Look, for whatever it's worth, and this is not, I'll say my cup of tea, Mike, but I'll say ours if you don't mind. We're not political animals, and we don't follow this day to day. But let's be honest, the Republicans ran on a platform of addressing the deficit and significantly addressing the deficit. We have a small election this November, and then we have a really big midterm election next November. I have to believe if the Republicans, this administration, doesn't do something more significant to offset the deficit, the Republicans are going to pay a price in November. And right now, the Democrats don't have much to run on, Mike. Let's be honest. They are doing quite a bit of infighting amongst themselves and can't seem to settle on a platform that'll have some kind of grip that they can stand on. But they might have one if they don't do something with this deficit. So there are rumors that they're going to have more bills to come the latter part of this year, that they will address some of these spending issues latter part of this year. We're in wait and see mode.
So now, thank you. We've just brought this show full circle because you said in the first segment that Trump, you think, I don't want to put words in your mouth, may dig in and may not budge off the August 1st, August 8th deadlines. So let's for a moment assume you're correct. So now, Dominic, if you're correct, are we now not putting a recession back on the table? And now, if we put a recession back on the table, good luck to the Republicans in the midterms.
Yeah, I basically, Mike, kind of answer your question with your answer,
Yeah.
which is we started out the year where most of the major Wall Street firms were talking about a 20-30% probability of a recession. That spiked up in April. You might remember, Mike, some of these firms were talking about a 60% probability of a recession.
Jamie
That's
Dimon, Jamie
yeah,
Dimon,
yeah.
JP Morgan,
I'll say way more qualified voice than mine.
and
Um,
mine.
I'll pick on myself, Mike, but we're talking about 60% probability of a recession. That now most of these firms are back in that 20-30% range. I don't think the tariffs in themselves and probably the volatility in the markets themselves cause a recession. But certainly, if consumers get really frightened, Mike, really frightened, we see spikes in the inflation data. We see real market corrections, and the consumer starts holding on to their money really tight and not spending, then you can almost write it in stone, Mike, we'll have a recession.
Exactly. Exactly.
Fear, fear can cause the recession.
Yeah, and yeah, well, look, we could just leave it there. Fear can and will cause a recession. Uncertainty will cause a recession. So I'm not necessarily saying I disagree with you that Trump is really going to dig in this time, but in the back of his mind, I said 1,000 times, no president wants a recession on their resume. I don't care what party they belong to.
Yeah, it would be a bad look, and you have to believe, Mike, which is why again I think I can say we cautiously optimistic through the end of the year on the economy, on the markets. because even if he digs in, trying to really kind of make this move along quicker than it's been going, we don't expect that he's going to go, oh, yeah, it's 100% tariffs and I'm never changing it, right? I don't think that is going to happen. I don't think you think that's going.
No, I do not. No, no,
But
no.
could we go a couple of weeks, a month, where it might get a little dicey for a little bit so that he makes a point and gets some deals done? I think that's possible, maybe even probable, Mike.
Yeah, look, I don't necessarily disagree. And you know what? We agree on the topic, which we typically do. So it's probably a good time to quit while we are ahead. So why don't we end it there, Dom? And we had a lot to go over tonight. And look, I agree with you. We both stay long-term optimistic, but I think we both agree short-term there could be some choppy market days over the next couple of days and weeks.
And it's all how you look at it, right, Mike? So if you're looking at it from a pure fear perspective, then some people might call or panic and get out. But the flip side of that is there's also opportunity in that volatility. If you believe longer term things are going to be positive, maybe if the market pulls back a little bit, that gives us an opportunity. So at this point, we choose to look at it as opportunistic and not necessarily doom and gloom.
Let's put a bow on it right there, Dominic. So
Good
thank you,
job.
thank you. So thank you everyone for joining us on the Lebenthal Report, and we will be back next week with a new show. Have a good night, everybody.
Good night, all.